So Bitcoin is historically highly correlated with various liquidity indicators, right? So basically, how much capital is kind of available, liquid for investment. A lot of other investments they trade off things like earnings, they trade off all sorts of other things. Whereas Bitcoin is actually one of the purest liquidity correlations that are out there. And ever since autumn of last year, liquidity conditions have actually been, in many cases, moving up or sideways a little bit. Basically, they declined all throughout 2022. When you got to the end of the year, the dollar index came off of its highs. You started to get China's reopening. You started to get, the market pricing in slower forward Fed hiking. Inflation was off of its highs. You had a drawdown in the Treasury General Account. That's kind of jargon for some, but basically, there's a bunch of things that improve liquidity. And I actually think that, Bitcoin probably would have bounced in quarter four if not for the whole FTX, implosion. Because you started to see a bounce in a number of risk assets. We saw good movements in precious metals, including, ones like silver, that are historically more cyclical. And so I think that basically this is kind of a pent up move from those overall better liquidity conditions. I think the somewhat concerning thing is that you're also seeing a bounce in like meme stocks and unprofitable stocks this year. And so, I wouldn't be surprised to see some of this be given back or some of this, consolidate for a period of time. But essentially, I think that, liquidity, at least locally, reached its worst point last year and at least is kind of a mild.
This week, Bitcoin rallied to a 2023 high at $23,100, and the move followed a notable recovery in traditional markets, especially the tech-heavy Nasdaq Composite Index, which gained 2.9% on January 20th. Hello and welcome to Money Talks. In today's video, Lyn Alden updates about her outlook for Bitcoin in 2023. She also breaks down the importance of regulatory clarity in the space and how it will drive the future of institutional adoption in crypto.
I think the biggest way it affects Bitcoin is how it affects their Grayscale trust, right? If this allows for redemptions, if this allows for a changing of ownership, if this gets stuck in a bankruptcy court for a period of time, I think that's the biggest impact there because GBT is an absolutely massive holder of Bitcoin. More broadly, basically, I mean, they own large amounts of venture positions throughout the crypto ecosystem. Obviously, they're a major trading desk. But I think it's healthy to go through these cycles and clear out all these malinvestments because, if you just always go up, of course you're going to get more and more leverage piled up. If you saw an investment that only ever goes up, the rational thing to do would be to leverage, right? If you were sure that it was only going to go up. And so the only way that something can go up structurally is that it has to clear out a lot of that debt every once in a while. And so basically, I think we still have a process to go through. If you look at historical Bitcoin bottoms, they usually, other than the March 2020 event, usually you don't have these V bottoms. Usually you go down, you crash, you capitulate, you go sideways for a while, and you correct both in space and time, and you clear all that out for a while, and then you start to build, right? So I do think that, even though we potentially have seen the lows, I still think there's time to go through before you'd see another just super strong kind of structural rally to new all-time highs.
Economic data continues to boost investors' hope that the United States Federal Reserve will reduce the pace and length of interest rate hikes. For instance, sales of previously owned homes fell 1.5% in December, the 11th consecutive decline after high mortgage rates in the United States severely impacted demand. On January 20th, Google announced that 12,000 workers were laid off, more than 6% of its global workforce. The bad news continues to trigger buying activity on risk assets. But Dubravko Lakos-Bujas, chief U.S. equity strategist at JP Morgan, expects weaker earnings guidance to put downward pressure on the stock market.
I'm looking at a lot as like the post.com recession, right? That was one where it was a major impact for markets and a smaller impact for the economy. But obviously, it's going to depend on how policymakers handle that. One thing I think is that a lot of people, they fight the last war, right? So they look back, for example, at the 2008 recession, and now they start to fear that every recession is going to be like one of those. One big difference that I point out about this setup compared to that setup is that going into 2008, banks were the weakest they've ever been in terms of they had the smallest allocation they ever had as a percentage of their assets to risk-free assets like treasuries or bank reserves. And they had maximum exposure to loans, to riskier securities, and they had very loose lending standards, which means a pretty small rate of default could render them insolvent. Whereas now, because they're much more highly allocated to those safer assets, it takes a bigger problem to cause them to be outright insolvent. And so, although recessions will impact banks, basically, for example, you'll incur loan losses if you do have a recession. I don't think the problem is going to emanate from the banks, right? They're not the epicenter of the crisis in the way that they were in 2008. And instead, I think it kind of, yeah, and that's how you get that explosive type of thing. When you have the banking system implode, that's more explosive. Whereas when you have it occur at the periphery, right? So first it's housing, right? Because the interest rates moved, housing activity slowed down. Also, auto loans have slowed down. The tech field, right? You have all these high valuation equities when cost of capital is free. Now that there is a cost of capital, those equity valuations have come down, which forces them to be more profitable, which slows their growth, which means you lay people off because some of that was just malinvestment. It was basically unrealistic expectations. So that gets slowed down. And of course, this keeps rippling through more and more and more sectors because, of course, those people that lost their tech jobs are going to now buy fewer other things. The people that are not building houses are going to buy fewer other things. And so this is like the type of recession I think emanates from the periphery and then moves in, rather than, say, the 2008 crisis that started from the center and then exploded outward from there.
The fear of recession increased on January 20th after Federal Reserve Governor Christopher Waller said that a soft recession should be tolerated if it meant bringing inflation down. Some analysts have pegged Bitcoin's gains to Digital Currency Group filing for Chapter 11 bankruptcy protection, allowing the troubled Genesis Capital to seek the reorganization of debts and its business activities. But more importantly, the move decreases the risk of a fire sale on Grayscale Investments assets, including the $13.3 billion trust fund Grayscale GBTC.
I think with the data we have at hand now, that's most likely. We recently saw, for example, industrial production came out pretty weak. We saw retail sales come out pretty weak. There's kind of broad-based deceleration. The New York Fed recession model is flashing recession. And so I think 25 basis points is probably the most likely scenario. Data between now and then could tweak those odds somewhat. Essentially, what we're seeing is that even though they're intending to continue tightening, they're intending to hold their tightness for longer, we are clearly seeing a deceleration of expectations around how much they're going to tighten, in large part because we've seen a deceleration in inflation and a deceleration in economic activity. So I think 25 basis points is most likely. I think around the margins, yes, because, for example, if you look at the Fed's mandates, they're not mandated to maximize industrial production, but they are mandated to maximize long-term employment, right? And so they look at basically employment and inflation as their two primary things to optimize for. By extension, they also have to optimize for financial stability. So, for example, if the treasury market goes illiquid, if the junk bond market, if that goes completely liquid and stops trading, they pretty much have to step in because that's going to start eventually cascading into failures of financial institutions and employment. But really, at the when it comes down to it, those two initial mandates are what they optimize for. And so the challenge, of course, is that employment is a lagging indicator, right? So usually you don't get substantial increases in unemployment until you're already in a recession. It's basically coincident or lagging compared to other things. Now, we can isolate certain aspects of employment that are a little bit more leading. So, for example, if you look at temporary help, if you imagine running a business and you're facing challenges, you're more likely to let go of temporary help services before you'd let go your permanent employees that have more experience at your company. And generally, so you see a lot more volatility and a lot of kind of a leading indicator from temporary help, both on the upside and the downside. And that's already negative year over year, the total people that are officially employed in that type of work. And so even in the labor market, which is pretty strong, we still see early cracks. Same thing for overtime hours. That's like another leading indicator. It's looking pretty soft. But as long as they're looking at broad-based employment, I do think that they can use that to justify staying tight for a little bit longer than you otherwise would if you're looking at leading indicators.
Derivatives data puts the bullish case in check as buyers using stablecoin margin significantly reduce their leverage and option markets are pricing similar risks for either side. On the other hand, bears have not found a level where they would be comfortable opening short positions by borrowing Bitcoin on margin markets. Traditional markets continue to play a crucial role in setting the trend, but Bitcoin bulls have no reason to fear as long as derivatives metrics remain healthy.
I think that's quite possible, but the thing is, I think where I would differ from consensus is that I doubt we're going to stay there. I would expect future waves of inflation this decade. If you look at past inflationary periods like the 1970s or the 1940s, they often came in waves, and that's because policymakers and central banks don't just sit there and let it happen. Central banks try to push back on it. They try to tighten conditions, or sometimes you have policymakers doing things like price and wage controls. That was a historical move that would happen. And so, between different types of levers that different types of policymakers can pull, they usually get a handle on inflation for brief periods of time before it runs away from them again. And so right now, as they try to curtail demand, as they basically suppress marginal demand, that helps bring inflation down. We also don't see, I mean, money supply was growing very quickly in 2020 and 2021. Basically, it was the fastest pace of broad money supply growth since World War II. But over the past 12 months, you're flat to negative in terms of broad money supply.
Right.
And so I would expect to see continued disinflationary pressures until there's a policy shift, in response to recession, in response to economic softness. And then probably from there, we would have another wave of inflation because some of the underlying shortages in energy supply, for example, are unresolved, even though they can be temporarily suppressed.
So, do you agree with Lyn Alden's take on Bitcoin? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.